Por favor, chicos, silencio, todos los que están acá, ya cuando se abra el tema de preguntas, se pueden comenzar a preguntar, ¿vale? Así que,
nosotros preguntamos.
si quieren, sí. Pero chicos, tengas silencio, vamos a comenzar y adelante.
All right, good morning to everyone. We are the directives of HSBC, and my colleague Diego, Ernesto, and myself, Guillermo. And today we're going to present the budget for 2025. So on the agenda, we have all the points necessary for this presentation.
So I'm going to present a little bit about who we are. So basically, HBC, we are one of the largest banking and financial services organizations in the world, aim to create long-term value for our shareholders and capture opportunity. We base on 4 values. We value difference, we succeed together, we get it done, and we take responsibility. Our strategy supports our ambition for being the preferred international financial partner for our clients, in focus and digitize to maintain leadership in scale markets, maintain cost discipline, and retain our portfolio, and also deliver seamless customer experiences, automotive and simplify at scale. Our global reach, we have around 3.3 trillion in assets and approximately 42 billion customers around the world, and we operate in around 62 countries as right now. And we employ around 221,000 to full-time equivalent staff. Next, please. So our global business, we focus on wealth and personal banking, commercial banking, and global banking and markets. There's a quick graph of our revenue divided in these 3 global businesses: 41% for wealth and personal banking, 35% for commercial banking, and 24% for global banking and markets. And we tend to maintain a strong relationship with our stakeholders to operate the business in a sustainable way. Next.
Now we're going to go over the assumptions, beginning with the sales assumptions. We saw a 10%, around 10% markup, growing exponentially over the past 3 years, I'm sorry. We've estimated a forecast of $69.3 billion in revenues. And for this, we are calculating our budget on 69, given the market's trends and our growth over the years. Next one. Now we're going to talk over the cost assumptions, where we see also the same ratio of growth exponentially. So we have budgeted for around $35 billion in net income. And it's projected to be around 35. And also we have included a lot of details, as you can see in our Excel files. Another important point, we have focused on cost efficiency, so our budget has been cutting expenses and growing our revenues, incomes, to maximize our net profits over the years. And going over to the expenses, we have projected also the same trajectory as a 10% growth over the past 2 years, and we expect to maintain it, growing, of course, entering new markets and growing with the market trends to around 30 billion income. Yes, non-interest income so far projected. Next.
I'm going to talk to you guys about the current assets of the company. So first, on the left side of the screen, you can see how our assets are developed and how they are put into different categories. First, we have our cash reserves. A significant portion of our current assets are located in cash. Our cash equivalents in Fed funds, so for around $558,000, ensuring liquidity for daily operations. And then we have investments in money markets, including total funds, risk agreement, and we contribute about $252,000 reflecting short-term investment strategies. Then we have our prepaid expenses and miscellaneous, which is about $13,854, and our assets. Our liquidity focus is we have a total amount of $1.9 billion worth in assets, which emphasizes our company's ability to cover short-term liabilities and having a great liquidity. And our cash dominance, as you can see.
So for short-term liabilities, we have a little chart of total deposits, trading liabilities, their private liabilities, other liabilities, and the total. Our customer deposits is the largest portion of the short-term liabilities, around 1.7 billion. Our trading activities are around 57,000. The derivative exposure 234,772,000, and operational costs and other liabilities totaling 329,124,000, representing various operational and miscellaneous obligation. And the total for the 2023 is 2.3 billion, demonstrating HSBC's substantial short-term financial competence. So for the CapEx, here are our 4 main investments for the next year. We're trying to focus on capture earnings tailwind from policy priorities and innovation. Around 400 million is going to be invested in that. 5 founding cash rates with multi-asset and active fixed income strategies, 600 million. Build out core allocation to private markets and hedge funds, 700 million. And discover domestic resilience in an evolving Asia. Let's remember that HSBC has a powerful presence in Asia, and they have been investing a lot in technology and in Asia in general, helping with also the investments with Europe, Americas, and I don't remember that. So the total for this is going to be 2.2 billion, and let's remember this is our priorities for next year.
We're going to look a little bit of our funding needs. So on the left side of the screen, you can see in blue the positive contributions of our funding, and in red the ones that take us. So we have these strategic investments. We have about $2.2 billion allocated for CapEx, as Ernesto mentioned, including innovation, private markets, and a fixed income strategy. We have a debt repayment of $182.3 billion. This is committed to reduce leverage and ensuring financial stability. Our working capital is about 3.47 billion in working capital needs to maintain smooth operations. And finally, our operating cash flows, we generate about $28.37 billion through operating cash flow. Then we'll have a look into our
Internal revenue.
internal rate of return.
Sorry.
Internal rate of return for our company for 2023 was about 34%, significantly above the company's WACC of 3.85%. We had a strong cash flow performance. We had a high return potential. Our comparison with WACC, as mentioned before, is a high comparison, a lot of differentiation. And our value creation, the IRR underscores HSBC's ability to generate returns that outperform market expectations.
So for conclusion, I divided it in 3 parts. These are some of the reasons why us as HSBC, our company, you can invest in. So the dividend yield, HSBC has a history of paying consistent dividends to its shareholders. Also the digital transformation now in 2024, we have seen how AI and all this technology has overcome in this new era of the world. It's actively investing in digital technologies to enhance its customer experience and operational efficiency and the regulatory compliance. As a global bank, we are subject to stringent regulatory oversight. This can instill confidence to investors and indicates commitment to the risk. Thank you. Thank you.
The next one is for
Questions?
Financial statement analysis.
It's in the next one.
Okay. So first of all, on the conclusions are not based to be invested. It's to approve the budget.
Only one. You put in the conclusions that you're investing in technology. How much are you investing? How is the percentage of investing in the cost of technology of making it better improve? I don't know, the technology about the income.
Alright, so in the CapEx, I mentioned some of the investments we're doing. Let's remember those are the priorities for next year, but
You
I
can
also.
show it, you can show
No, if you can go back to the CapEx.
it.
And more.
There?
No, the CapEx.
Capital.
One more? There, no, two more, sorry. There you go. Nope, too much. There you go.
So, do you wanna know how much it represents?
Yeah.
How much it's 2.2
So
billion
our total
represent
income,
from
our
the
total
total
income for 2025 would be around 69 billion. And it's around 2%, I think. No, sorry, 1.3% is what we're gonna be investing from our total revenue. Competitors, we're gonna see in financial statements in a minute.
Okay, go to the cost assumptions, please.
Right back. No, más atrás. More.
Costs.
More. One more, two more. There you go. This one. Yes.
What are you presenting to us? What's a cost? I didn't get what's a cost because I'm looking for total assets.
Yeah. Okay. That was a mistake.
Okay, so
We have in the Excel the official.
don't worry.
But it's
Explain to me, what's the operational cost?
So operational cost. Well, as you can see, the table is wrong, but our information is correct. So the total cost is around 35 billion to operate. With write-off, we have around 3.3 billion.
But explain to me what's the cost?
What part?
How do you
Calculate?
what's the cost of your operation?
Our operational cost
It's only technology, people.
is technology, of course, people, management and infrastructure. So all our physical locations around the world. We have around 20,000 physical locations.
Okay, the rent is part of the cost.
Yes. You'll be able to review it in the Excel,
You tell
but we do have it.
You tell me.
Rent is in there too, of course, salaries, dividends, yields, investment in new technologies. All those are costs that we take into account. Mostly also benefits and wages.
Which is the main cost?
Main cost is, I do not have the information available. So Excel.
Okay. And why did you choose 10% of growth?
It's a trend that we have seen over the past 3 years. We had a bad trend 4 years ago, I'm sorry, where we saw a loss due to various.
Can you go to the income? Sales assumptions.
Sales assumptions. No. You got it for
Another one.
So, in 2021, which is not presented here, we did have a higher rate than in 2022. To get an accurate assumption of how much we're going to grow over the next years, we took down from 2022 to 2023, and we saw a increase in 10.1%, which is around what we have forecasted for our budget in our revenues.
What's your main source of income?
Our main source of income, of course, is as if you can go to the second slide. There's our graphic of of how much. We have personal and wealth banking. Personal banking and wealth, of course, is 40% of our revenue. then commercial banking, of course, is 35, and global banking markets, it's 24.
Okay, what's the key product?
The key product is management of personal funds. So ultra high net worth persons are a big market of ours. In Asia, we have a strong stance there, as well as in Switzerland. A bit of competition there is with UBS, but beyond that, personal banking is one of the biggest ones. Managing ultra wealthy people's money is one of our key income.
And we also work with small, big businesses and individuals, so we vary a lot what we work with normally, so it's a big portfolio. And
Okay, if the rent and the employees are in the costs, can you show me what are the things?
Yeah. So if you go to expense assumptions, one more. One more to the side. Yes. So here we do have the correct table of our expense assumptions, and it's no. So part goes into taxes, part goes into wages and salaries, other parts go into each management of funds and more.
Also, if you would like to know the answer to your question of the how much was HSBC invest in technology. Seriously? That's it?
No, forget it.
yeah,
Here's how much
Yes.
HSBC.
As of we operate in 62 countries, correct? So we have a big global reach.
Okay, guys, let's move on. Let's move on to the next Adelante.
Thank you. So again, hello everyone. We're going to be presenting for financial analysis, our Capstone project, towards our more financial side of the business, which is more if we're going to invest in our company stock. As well as we mentioned before, my colleague here, Ernesto, Bakis, and myself. Our agenda, of course, the points that we're going to cover.
Alright, so we already covered a lot of this. So just to mention, we were founded in 1865 in Hong Kong, and our headquarters are in London, United Kingdom. We have a big global presence over 6 countries. We already mentioned more than 42 million customers. And our mission and vision are to be the world's leading international bank, helping customers thrive in a globally connected world, and to open up a world of opportunity. We can move forward. There's a quick business model of these are 9 of the most important points. Our customer segments, I mentioned it before, we work with individuals, businesses, and institutions globally. We value proposition, providing international banking solutions, facilitating global trade, and offering tailored financial products and services. Our key resources are global network, financial capital, technology, infrastructure, and skilled workforce. And our key activities, lending, deposit taking, trade finance, wealth management, and investment banking operation. And for last but not least, our key partners are mainly governments, financial institutions, technology providers, and strategic alliances in key markets. Keep going. So for differentiators, some of the stuff you mentioned also before, our big presence or global network, the strong presence in Asia, around 50% of our revenue comes within the Asian continent. So that's a big portion of it. And expertise in international trade and finance, our comprehensive range of services, and commitment to sustainability.
Now I'm going to talk to you guys about our competitors, who do we chose to compare our business to. First, we have one of the giants of the banking system, JP Morgan, Bank of America, and finally Citibank. So JP Morgan, as most of you know, is the largest US bank by assets, and it's also known for its strong technology adoption and diversified revenue streams. Bank of America is a major bank with strengths in consumer banking, investment management, and a vast retail banking network, which focuses on digital transformation and personalized customer experience. Finally, we have Citibank, a globally diversified bank with operations in over 90 countries, specialized in corporate and investment banking, and with a unique focus on global markets and emerging economies.
No, go back one.
So they have a strong profile. JP Morgan has a strong profitability, metrics and efficient operations. They have a dominance, as mentioned, in investment banking and asset management. Bank of America is one of the most extensive retail network in the US. They are the leader in digital banking adoption. Citibank is an extensive international presence and with a strong in global capital markets and corporate banking.
Next, one more.
So here's the ratio analysis for HSBC. The current ratio is around 0.9. The quick is around 0.40. Our cash 0.10 and debt ratio is 0.08. Our debt to equity ratio is 1.26 and ROE 12.73, and our ROA 0.77%. So with this number, we can say that they're pretty low, but this doesn't mean that HSBC has been doing bad in terms of financially talking. Taking into consideration, we work with billions and billions of dollars. These small numbers don't punch us directly, and we have maintained growth in the last few years within these ranges. There have been a little bit of changes within the last years, but we have maintained between this, and this hasn't bothered us financially, or we haven't had any problems operating and with all of that. So continue.
Now we're going to see about the personalities. So in order to comprehend what we're going to talk about, we focus on liquidity, leverage, profitability, and coverage. So as you can see, HSBC's current ratio is 0.90, which is above, the same as Bank of America and lower, above JP Morgan and Chase and above Citigroup. They have a leverage of the ratio that's about 0.8, which shows a really high superiority over the competitors. In profitability, they're in second place with the highest ROE among their competitors. When talking about coverage, they maintain a strong interest, but slightly behind JP Morgan Chase.
Going over to our first stock value, we did a comparison of our stock with the current price. As you can see the graph, this is our current price, which is 48 as of yesterday at 5 p.m. And doing a fair evaluation of our whole company, we managed to successfully rate it as a 49.26, which means we're currently undervalued in the global market by $1. We do have a WACC, well, in a minute I'm going to explain our WACC, but we do have a successful WACC of 3.85, and we're running out of time. But yeah, mostly that. Okay, ROI, we already explained it in Managerial Accounting, so we're going to skip over it for time reasons. We go to the next one, which is the WACC. And after calculating our WACC, we got a 3.85% WACC ratio. Our current debt, cost of debt is 3.89%, which has is according to our tax shields and are reflecting debt utilization. Our cost of equity, my apologies, is 5.50%, which is the CAMP model is a risk-free rate of 3.5, and the beta is 1.2, and the market return is around 9% compared to a global strategy. Our capital structure weights is 87.76%, and our 12.24 equity emphasizes resilience in our financing debts. We can go to next forecast.
So we're going to see briefly our 2025 balance sheet forecast. As mentioned before, we have approximately a 10% increase in years, as we have been seeing the last 4 years. We have a revenue growth for 2025 to be forecasted at $69.54 billion, reflecting a steady increase from 63.02 from 2023 and a 56.02 in 2022. We have an interest income dominance of about 3.89%. We're cost effective. We have a stable non-interest income and a profitability strength.
Yes, can you finish up? And our profit and loss forecast, as mentioned before, we have a revenue of 69 billion expected for 2025. In income interest, we have a dominance of cost of debt of 3.89%. Going over also cost efficient, we have a cost equity of 5.50%, which is capital derivatives. We have a stable non-interest income that consists of a capital structure of 87% and 12% of equity. Our profitability strengths, due to our low WACC, it indicates that HSBC has access to low cost capital, providing a competitive advantage in funding and profitability. Going over to
So in conclusion, are similar to what we saw in the ones before. The global reach, HSBC extensive global networks allows it to capitalize on diverse markets. The strong financial performance has proven to track record of profitability and dividends payouts and commitment to sustainability.
Thank you very much.
Do you recommend to buy?
Yes,
I do recommend to buy.
Currently, with our ratio analysis of our stock, we do recommend to buy.
Okay, go to the ratio analysis, please. Avoid using adjectives because Ernesto, you mentioned that in that ratio analysis you mentioned that your numbers were low, but as I see the peers analysis, can you go to the peers analysis? It doesn't seem low.
I didn't mean low, but it can be considered like with low liquidity in some cases, like
It doesn't appear to be low.
when I check it was.
It's you have a current ratio. It's the highest of them all. The current ratio. The current ratio is a little bit low, but as it says, it's fine. So we don't have any concerns regarding liquidity.
Well, that's good to hear.
That's good to hear.
Guys. Okay. Would you reply? She doesn't know anything regarding banking until now.
We cannot state. We cannot tell you too bad.
What is the main indicator you chose to conclude that you will buy?
It's our comparison with the WACC and the ERR, and once you compare it, we're able to determine our
ERR compared to what?
to the WACC.
To the what?
Our ERR is 34%.
But what if in another bank you have a higher IRR?
Well, then we would invest in another bank.
No, you have very good
And compared to a global spectrum.
Something happened in Citigroup. Something happened. but you have an ROE of 12%, 12.7, 16.28. So basically regarding how you manage your equity, your height, and take a look at the profitability numbers. Gross margin, you have 60% compared to all of them, you have the highest gross margin. And the operating margin, it's the highest operating margin.
We're happy to be a part of HSBC's successful year.
Those are the important figures that you have to take into consideration. Okay? Well.
Any other questions?
I think
Everyone's on the phone.
To present for our financial statement analysis Capstone project. This is our team, Dia, Daniela, and myself. So before we start, this is our table of content. And before we start everything, a little bit of company background of where we, what does Grupo Playa does. Okay, Grupo Playa as a result is a company focused in upscale inclusive results in all the Caribbean and Latin America. It was founded in 2006 and it partners with major brands that deliver luxury in rich producers. The business model is three main points, which is all-inclusive funding, which means that it includes accommodation, food, drinks, dining, and entertainment. The targeted clients includes both family and also all adult resorts. The locations are highly on beach and really demand beachfront places. And the key differentiators are strategic brand partnerships. It allies with Hyatt and Hilton, and this causes a really brand recognition. The target offerings that separate whether it's a adult result or a children result. At the prime location, the high demand is in Caribbean properties, and this ensures like a premium appeal. And the main competitors include AM Resorts, Sandals Resort, and Royal Tip by Marriott. They also are inclusive and they are also luxury, but they have different target markets and different locations and all around the world. The picture shows some of the hotels that Papaya owns.
So here we have our forecasted 2024 income statement. Here we have a graph that represents in thousands the total revenue that this company has been showing from 2020 until 2023. 23, I'm sorry. Here we also have our 2024 budget. The forecast for 2024 serves as our foundation to this budget. We can observe through the year's forecast and budget that the total revenue, operating revenue, but also the cost of revenue is increasing. For the 2025 budget, we have a high amount for cost of revenue. Remember, these amounts are presented in thousands. So that's why we have, as a result, a negative amount for the operating income. But this could be changing through a lot of trends and also because this is for the past data that we have, and we have to take into consideration too that the data was from the years 2020 and 2021. And in these years, from the pandemic situation, and the hotel industry was completely closed.
So here's the peers analysis, and as we can see, Grupo Playa has an efficiency in managing their costs, and this can be seen in the gross margin. We have also a superior operational efficiency compared to our peers, and we have a stronger net margin, and we can see in the 2023, and we always need to be comparing it with our other peers. The profitability of the company indicates better returns on assets and also a better return for our shareholders, which is something good for our investors. And this can all be seen in the profitability ratios. Then the liquidity ratios, we can see that we have the ability to pay the short-term debts in cash and not taking money from the inventory. And the liquidity means that we have enough money to cover expenses or unexpected costs that can happen. And in the cash ratio, even though it's a little bit lower, this doesn't mean something negative. This only means that we need to be aware when there is a financial crisis or a uncertain cost in the market. The net working capital differentiates the company through our current assets and our current liabilities, and the financial cycle is how quickly we can receive the payments from our customers, and we have a good percentage. We can see that Grupo Playa is more effective in collecting payments from our customers, which is a positive sign of our financial health, and also that we have a good relationship with the customers, a good customer health also. And we have also that our company sells and replaces inventory in a good way, and we have a good management of our inventory. And the lower APC, which is the average collection period, indicates that our company requires the payment from the customers quickly, and it also we take a little bit longer to pay to our suppliers, but this is a strategy to improve the cash flow, so we don't have problems, as I said before, when we have a financial crisis. The average of numbers that it takes to our company to sell the inventory, it's a shorter period than our other peers. And the efficiency company working capital can be improved in the cash flow management, but besides that, compared to our peers, we have good numbers, and we are good managing the working capital, the current assets, and the current liabilities, and this is to maximize our operational efficiency and our financial performance during the year. Grupo Playa has demonstrated a strong profitability and operational efficiency compared to Hilton and Marriott during the years.
So for our stock fair value, the company's stock fair value is 11.42, considering the WACC that is the WACC as well as the stock value in 2020, which is 7.47. And the actual value, which is 9.69. We have to consider also that this company does not pay dividends. The WACC for this company is 11.19 compared to the WACC calculator to the hotel industry, which is 10.5%, and there's no a big difference between both percentages. And with an effective cost of debt of 6.44%, and also a cost of equity of 22.99%. That this explains why Playa is financed 71.31% with debt and 28.69% with equity. It has a higher cost. Our internal rate of return is 5.34% compared to the treasury bonds, that is 4.28. It's higher, but it's not a big difference between this value. This is value with the cost of the stock also in 2020, and in the actual value that I already said is 9.69. So as our conclusions, if we recommend you to invest in this company or not, is if you're interested in investing in the hotel industry, we recommend you to invest in Playa Group. Why? Because this company shows higher profitability and liquidity and better results than its competitors like Marriott and Hilton. But if you're not interested in specifically invest in the hotel industry, we recommend you to look for another one that will give you a higher internal rate of return, and so you can get more profitability.
This is for financial statement, right?
Yes.
Questions? Can you go out to the peers analysis, please? Okay, the peers analysis, what happens? You are the most profitable company of them all, okay, but not at net margin level. From the operating margin until the net margin, there's a substantial decrease in the margin. From the operating margin to the net margin, there's a substantial loss of profitability. What is happening? Yes, the gross margin appears to be amazing.
According to what you have said, it's because something's happening in the manufacturing part. So that's why they are.
No, but in the manufacturing part, you have a gross margin of the highest. What is happening from the operating margin until the net margin? What expense?
We have high operating expenses, but also more high, like
Which one?
the operating expenses. Those were like the labor, the administrative expenses, because they were a little bit higher than the other year. No, we were like reducing them, but they're still high. Due to all the people that we are hiring because we're opening new hotels, so we're increasing the like people that we're hiring.
Okay.
That one.
And regarding the financial cycle, do you need funding? Do you need funding to finance your financial cycle?
With funding, you mean the investment?
That you need working capital for your financial cycle?
Yes.
Because it's negative. Why it's negative? Why is your financial cycle negative?
Because the average collection period is higher than the payment and inventory period. We don't have like a lot of inventory. That's why our competitors doesn't have like data here. They don't have inventory. This industry doesn't have so much. The collection period is higher than the other ones. That's why.
I don't know what type of inventory your hotel has for food. Maybe they consolidate food.
Maintenance.
It's a cheap and higher cost. It's another company. And give me a conclusion regarding your liquidity.
So compared to the competition, there is Hilton and Marriott, we have the most liquidity ratio, like it's the highest. But also Hilton and Marriott, as we put in Excel, they're having issues with a lot of their finances because of booking and all of this. So we are better than the competition when it comes to radio because we're the highest one.
Like we have the ability to pay the short-term debts. And that's what, like, it means that we have the cash now to pay the short debts and the expenses and the costs that may happen that are not registered or that we don't have considered. If we have some costs like that, we have the ability to pay them without taking money from the inventory.
Okay.
Can you show the budget, the one that?
No, but the budget is good.
Yeah, I don't know.
Why did you budget a loss?
Because of the high cost of revenue. Mostly.
Guys, rule of thumb for everyone, please never budget losses. Never budget losses. You have to always show profitability. You're telling me that the next year I'm gonna lose money because you're not capable of cutting costs or saving something. You have to explain why are you losing. There are cases, occasions, no, like I know pandemics, for instance. But if you're gonna budget a loss, you have to tell me why. Okay. Very good, guys.
We're gonna use the same file now for managerial accounting. Our team is now Mabela, Anila, Sarah, and I. It's our table of contents. And we're gonna start with sales assumption, which is the most important one, which is the sales channel. We have three: online, direct, and travel. As you can see, online dominates with 1.5 billion. That is also supported by direct sales and agent. So the average ticket for booking is 1,200. This is reflected on the transaction side, and the ticket already includes where it comes like all inclusive, which is food and dining. The customer commission, which means the percentage of customers that enter to the page into a booking is 5%. So we multiply this by 12.5 million bookings, and the percentage we obtain the total bookings in a year. The customer retention is 65%, which is customers that visited the hotel relating to a loyalty program to make effectiveness. So we have our repeat customers in a year. We have the average tax per booking, which is 2.5. If we multiply this by the bookings in a year, we obtain the number of people that are staying in the hotel, which is approximately 2 million people. The average sales per night is 500. If we multiply this by saying that the customers are going to stay 3 nights, we obtain 1,500 per booking. And our marketing efficiency is to spend 75 million on marketing. That gave us and generates 1.5 billion sales. This basically helps us to reach the conversion and the retaining targets.
Now for cost assumption, our cost goods sold, we have accommodations that overall is like all the amenities that you require for preparing a room. We have this represents the 35% of our cost. As we saw in the income statement for the budget, we have a high amount for cost. So our strategy is reduce this cost. But the 30% of the accommodations cannot be reduced that much because we are investing to make this company like a more high-end group. We cannot like reduce that much this cost because the guests expect like higher amenities, better quality for all the room preparations and all these things. The 35% represent 323.4 million. For the food and beverage, this represents the 30%. This also cannot be reduced that much because we are all-inclusive hotel company. This represents the 277.2 million. This is food, beverage, and kitchen operations. We have staffing or labor. This represents the 20%, but we aim to reduce that in the future with new technologies, like the guests can check in by an app or by a special place where no labor or no staff is required. The utilities that are like energy, water, and waste management expenses represent the 10% of cost. We put a lesser percentage for utilities and for maintenance and repairs. Why? Because we aim to reduce them. The utilities by using the renewable energies that we already bought, like solar panels, and also for the water, as we have all our hotels like next to the beach, we have a lot of water desalination plants. So this help us to reduce our cost. Also, we work with companies that certificates us as a company that cares for the environment, and this is even for attract guests, but also to reduce costs. And the maintenance and repairs. This is our lower percentage with a 5% that is 46.2 million. Because as we're reopening our hotels after remodeling them and also buying new of them, well, they don't need like a lot of maintenance because they are like new or just remove them. For our expenses assumptions, we have our administrative costs. Our budget for the expenses is lower than the cost. We have the administrative cost, which is 180 million. That remains at 40%. This includes all the salaries for the management, offices, operations, and insurance. Our marketing and promotions, which is 90 million and at 20% of our budget. The technology in where we're investing to, that is 67.5 million. The training and development, as I said, we are recruiting more personnel to work in our hotels, and this is 10% of our budget. And last, we have the miscellaneous cost with also a 15%, that is 67.5 million. We have our cost assumptions in the amount and the percentage, and there is also our office, like in total.
So for current assets, and as you can see from 2023, it's has had a slightly the number projected has a 13,000 difference. Sorry, and it's a small drop, but the company shows that it still maintains a solid level of short-term assets. And some of key components of the current assets, the most important one is cash and cash equivalents, receivables, and inventory. For the cash and cash equivalents from 2022 to 2023, we observed a decrease of around $10,000. A similar decline is projected for 2025, as you can see. And this is because they use the cash to cover short-term obligations such as debt and operational expenses. Then we have, for receivable, we have a difference from 2022 to 2023. We have $15,000, indicating an improvement in the collection of debts. However, in the 2025, a smaller decrease of only $3,000 is expected, and this is because the accounts receivable directly affect cash flows and liquidity, and for inventory has remained stable and around 19 million approximately in 2023, and this ensures that the company has the necessary resources for its daily operations. And although current assets have decreased slightly, the company continues to maintain a solid base of liquidity to keep doing its operations.
Okay, there's nothing a lot to say about short-term liabilities, but we're expecting to have a reduction on the total liabilities on the next year. But this doesn't mean anything bad. It means that we also have a better distribution of the debt in the company. So this also means that the company is going to implement better strategies to get, well, like to have a better gestión of their responsibilities of their debts. Like I said, this doesn't mean anything bad. It also means that the company is getting better strategies for the company to gestionate their liabilities, the assets, and many things. Now, for our capex, we have short, medium, and long-term investments. For the short-term investments, we are developing a new marketing strategy to attract large group bookings, because our main customers are the large groups that book even all the hotel. So we have a budget for this certain investment of $10 million. We are anticipated rate revenue of increase to 100 million. This is an expected return on investment, approximately like 1,400. For the midterm investments, we are renovating and upgrading our resorts to increase the ticket price and also to attract premium customers and have like a eco-friendly features. This amount, the $40 million, was established by consulting with engineers, architects, and designers to have like an estimate of how it will cost. This has an expected return on investment of approximately like 875. For the long-term investments, we are rebranding and upgrading our hotels to convert all the cheaper ones to Hyatt properties, because the Hyatt are more like they have like premium customers, and we like have a budget of 40 million, but we aim to increase this budget to like convert more hotels to Hyatt properties. So we want to increase this amount, and this is for 5 to more years, so we can do it. This has an expected return on investment of 1,200.
That's awesome. Perfect. So
No questions.
can you go to the, you have a lot of questions, right?
No.
Can you go to the income statement, please?
No.
Oh, in the sales assumptions, please. Okay. So what's the biggest source of income for the hotel?
The direct bookings.
What does it mean online?
Online, we have our webpage. We work with agencies, but we also have our own online webpage where you can book your stay with us.
Okay, and can you go to the cost assumptions? What?
Food and beverage is like, okay, I think it's more or less like the one that my hotel have, but accommodations is higher,
Yours or this?
not mine. So it's, I don't know, room
Well, they're
preparations and
separating
cleaning.
staffing.
You're counting all the stuff?
Yeah, for the area too.
If you add the staff, it's 55.
And also, as we are reopening the hotels, we have like to pay more for cost for all the room preparations, like all the new things that we need for the rooms.
Go to the income statement, please. Income. Okay, this is the final result. No, the thing is that
No negative.
it's the loss that you have. Okay. Can you show me the cost, please? Auto expenses. Okay. I don't see the 654,000
For the OPEX?
for the OPEX. You have 450. You're considering the CapEx, the capital expenditure, as part of your operating expenses. 653. The capital expenditure is part of your investments, okay, and your investments are part of your if you invest in a building, the building is an asset. That's why you're losing money, because you're putting the assets as an expense. Okay? Just be careful with those things, guys. It was a good presentation. Thank you very much. Thank you.
Okay. Good morning. We're here today with Ms. Natalie and Zaira. We're going to present and then talk about the financials about Target Corporation. And yes, so, okay. Here is the agenda where we have the company overview, target map, income statement forecast, balance sheet forecast, peers analysis, the WACC, and the company share value.
The conclusion is to buy or not to buy the stock.
Yes.
Yes. So we can start talking about a company overview, a very quick overview of the company. And as you know, Target focuses mainly on, has focused for the last years and even generations, no matter what challenges they have, and investing on their stores, investing on their operations, and delivering and also focusing on these cheap prices for customers. And up to in 2023, they returned to what we can tell it is a normal in their financials, where thanks for all of their hard team work, they could met their goals in this year. Once again, going back to normality after COVID. So they in this year they were up to say $500 million, and they also up to 2023 they met their expected goal, where about their expected goal is increased by 4%, their revenue 4% every year, and building the 107 billion they got in the last year. So they have been investing in technology, they have been investing in having more stores, and even in AI to make their revenue increase. So you can accept. We can also see here that Target is located in most parts of the United States. In some states, there is even more. They have up to 1,900 stores in all of America. So this is how they're doing this.
We actually need to add that, for example, one point, it doesn't mean one store, it means each real point covers 10 mile radius with at least one location. And the black points, it's greater than 5. So it's pretty similar actually. Okay, so now I'm going to present the income statement forecast. So we've seen, for example, with the cost of goods sold, like talking about the Target's costs, is more about merchandise procurement, logistics and distribution, shrinkage,
Selling general and administrative expenses is mostly composed by employee benefits, marketing and advertising, store operations, and technology and digital investments, such as ongoing expenses for ongoing upgrading Target's website. So that goes a lot of money into the mobile app and that kind of stuff. Another very specific cost that they have, for example, for 2035 is forecast 83 billion. So it's more for e-commerce fulfillment, automation, and logistics technology. So yeah, in the sustainability, somewhere initiatives, targets, commitment is very important to say that their commitment to reducing the carbon footprint for 2040, it also adds into the cost. As stated, it's a lot of investment in renewable energy and energy efficient storage designs with sourcing sustainable raw material for products. So this is the forecast we can see. Looking at Target's projected income statement for 2025, you can see like a clear upward trend in annual revenues with consistent growth over the past 5 years, starting from 93.6 million in 2021, and well, we saw this highest point in 2023 with 109, and we forecasted for 2025 115. This suggests that the company has a strong capacity for recovery and sustained growth, driven by effective business strategies and marketing adjustments, clearly. Yeah, and this will is a positive trajectory for the balance sheet. Here we go. Target's 25 financial outlook shows a healthy and well-balanced structure with total assets reaching the 56.4 billion, up to 3.65% from 2024. There's notable highlights like in current assets, they have a 20.5 billion and driven by a 41.42 increase in cash and cash equivalents, and inventory rose to 13.2 billion as signaling adequate preparation to meet future demand. So though we've seen like a general increase a bit, Target's equity position is a major highlight, with stockholders' equity increasing 16.38% to 13.72 billion, showcasing strong shareholder value generation. Overall, the 2025 balance sheet underscores Target's commitment to sustainable growth, operational efficiency, and shareholder value creation, setting a solid foundation but to long-term success and profitability.
The first analysis we're comparing Target with the one of the biggest competition that are basically on Walmart. We can see that at least in the margin, Target and Walmart are really close, because Target is still having a higher margin. But historically, Walmart has been with a more stable margin in their history. We can see that this is the return on equity. Basically, it's higher than Target, and about the return on assets, we still have Target as the highest one. But like I say, if we like take in account the history of their budget, etc., we will still have that Walmart is still more stable, but Target has the analysis was that Target has some better strategies, and they are getting to they have a they have better control of costs, and this suggests that it has a better business model that is more like profitable in comparison to Best Buy, but Walmart is still a very strong competition, so they are like more or less in the same. And about the WACC, It's a very stable work actually, and this work also means that the company can answer investment projects with lower returns and still add value to shareholders. So it's not a bad one, but it's not the best one if we take in account our ERR.
Okay, now we can talk about the company share value. As you can see the table here, it's basically the money coming in and coming out, for example. And there's an upfront cost of 126, as you can see. And then at the end, there's a big return of 127.4. Then we can see we can talk about the IRR, and it's at 2%. And this shows how much the company how much profit the company could make from an investment, for example. And 2% IRR in this case means that the project hasn't been growing as quick as they expected, but it's growing, but it's growing slowly, as you can see. For example, in the tier, this is basically the same idea, right? And in this case of target, what the percentage of return in another way we can say. Here it is close to 0, for example. So the project in this year, in the share value, isn't as profitable as we thought. And here we can see the present net value, that it's negative 0.91. This is the total value of the investment after considering the costs. And well, at this moment, we can say that the investment would make a lot of profit as we thought, right? So seeing these values, we can say in this time that it is a company that always maintains its level. They have a main goal of increasing of 4% each year, but this year, but a lot of factors about the cost and everything, we can see that there hasn't been a growth in it. So we could advise that at this moment, it is not a right moment to make a big investment on the company, but it is a safe investment because it never drops. It always maintains like the same margin. So it has a lot of projects coming in. For example, they're planning to invest in AI a big amount of money and reducing operational costs by reducing staff, things like that, like making AI projects in customer service and making the analysis. So it can be a very good investment in the long term. So at this moment, we can say it's not a loss, but it is like something safe. But it could be a very good investment.
Why in the long term?
Because they have a lot of projects that to invest in a long-term period. As I was saying, there's a big project coming to target, an AI project, and that it is gonna affect in all the United States, where they're planning to reduce costs, where they're planning to cut staff by making customer service more based in an AI. So here they're planning to reduce their cost by in this area, for example, and including in AI in all of their operations, for example, in all of their areas, different areas, customer service, inventory, their analysis. They have this big project, so as we can conclude that it is a very good investment, but in the long term. At this moment, we don't advise to invest a big sum of money, but it is a safe investment, we can say.
Can you give an example? What are they planning to do with AI, like for sales?
Of course.
You go into the store and what happened, or they are emailing something, or
It's actually, for example, Connect, right? For the drive up, order, pick up, the ship delivery, contribute sustainability channels, and a lot of, for example, the cross-channel integration. That's that many customers start their shopping journey online and complete it in store. So they're trying to optimize all of that process.
They are planning to reduce labor costs by, for example, tasks like inventory management, customer service, as I was saying, data analysis, and this will reduce the manual labor, for example. Or also they are planning to make the marketing AI driven, which would be personalized marketing that can improve the return on investment, for example. Also, they are planning to base all their customer service with chatbots, AI chatbots, to also be all managed by this type of technology.
And they're trying to make to open new small stores in more urban areas, so that is like a lot of boost for 2025 also.
Can you go to the income statement, 2023? Income statement.
I mean, let's see.
You were there, right there.
Yeah. Would you like to know the biggest revenue from?
Uh, No, there are no more questions, guys. Thank you.
Yay!
Thank you very much.
So we're gonna present Valeria and Genevieve. First of all, this is the agenda. About Disney. Walt Disney is together. They are the diversified international family entertainment and media enterprise in the market. They have three main core segments, which are the Disney Entertainment, ESPN, and the Disney Experience. Disney Entertainment is all the streaming they have. The ESPN, it's the ESPN network and their international sports channel. And the Disney Experience, that are mainly the parks and the resorts they have. They market, they are in five major segments, which are the media networks, the parks and resorts, the student entertainment, the consumer products, and the interactive activities they have. These are their mission, vision, and values of the company.
Okay, so before showing our budget, we wanted to show the results of our forecast for 2025. So we based that total revenue on the previous years. And in the 2024, that's not the complete year, that's why it's a little bit less, but it should be more. And we can see that it's growing exponentially like it's going up and the total revenue is increasing, as well as every one of the other aspects in the statement. And also we have the results for the balance sheet, which are the assets, the liabilities, and the equity. And we can see that also it's more a linear growth, but it's like it keeps the same amount of total assets and total liabilities. As well, in 2024, it's not completed yet, so that's why it's a little bit less. But that was retrieved in like middle of November, so it still misses some income. And based on those results, we created the budget for 2025, which is of $104 million. So we have 6 categories, but the 3 more important ones are the content production, the parks, and the advertisement. The one where we're directing most of our budget is to the content production, which is the streaming, the movies, and TV shows. And the next one is the advertisement, like the global campaigns and just all of the advertisements to create more customers. And also the big one, which is the park and creating new experiences. And we're gonna explain all of these on the following slides.
So first of all, the sales assumptions is divided into 3, in 45% for the Disney Entertainment, 30% for the experiences, and which it grew with a 7% in the first quarter of 2024, which is a big growth, and the other percentage is for the sports, the one that I shared for ESPN. Then why we assign the 28.85% to content production? The subscription revenue is from 60 to 70% of Disney Plus and Hulu, and the licensing and theatrical is from the 10 to 20% of the revenue. And this is
This includes the cinema, which that's referred to the vertical, and why do we need to think in that? Because the new production is crucial to maintain the leading position in the entertainment market. And we assign 19.13 to the parts and experience because the parts and experience are the central point of the Disney brand experience, and this means that in the 2024, the gross margin was around 36%. So for every dollar that Disney received, about the 36 cents were from a total revenue. And the new attractions in the parks are essential to continue with this revenue. Then the marketing and advertising has a 24.4% because the streaming and the Disney advertising reach is around 5 and 8%. The theatrical is around 2 and 5%, and this permits the audience to have like a loyalty, and this also creates popularity for Disney. The advertising revenue of the marketing and advertising is from the 20 to 30%, also from Hulu and Disney Plus. That's why we need to continue investing in that category. Then the distribution and logistics is 14.42, and it's because it will increase by 2 or 4% in the operational cost to translation. So this includes the supply chain management, the e-commerce, and the inventory management. And the other last two categories are the research and development, which are 4.81. And now we have 2 locations in LA and in Switzerland, and they have been making developments, but these ones are the main costs that we have been investing in, and I put all the costs to have an approximately amount of money to know why we are investing in that, and the general administrative expenses, which are the equity costs, the operational costs, and the corporate overhead, the taxes and fees.
Now we're going to take a look at the expense assumptions. So the first category we have is the operating expenses, which is Disney's largest expense category. It's the most money that they do has a revenue. So first we have regarding the parks, the salaries of all the employees, the utilities that they use, and then also the food and beverage costs that they use for the in-park eating. Next is the media with the licensing fees and the platform hosting. So especially with Disney Plus and now that they have Hulu and ESPN Plus, they do have to pay for them to be on their platforms. Next is the administrative expenses, which are the salaries of the employees, and we are looking at in 2025 around 3 to 5% increase because of inflation and all that stuff. Next is the marketing and advertising. So these are the promotions for the streaming platforms and films that Disney is doing. Next is a really big category that we are trying to implement more on is the research and development. So we are going to invest a lot in AI and in emotional intelligence, not emotional and virtual reality, especially with the new parks that we have. Disney is looking to implement a lot of new fun interactive games for everyone involved. And also in promoting with Disney Plus, they're looking to do AI for a more direct marketing campaign to its customers, so it's more for them. Next is the debt servicing. So these are the interest payments on the debt that Disney has. So especially with Fox Entertainment, it's not a part of Disney, but they do have Fox Entertainment on the Disney Plus app. So they do have to pay the debt servicing for that. And in total, we're looking about around $44 to $50 billion. Next, we're going to be taking a look at the cost assumptions. So the first category is the parks and resorts. Like I said, mentioned before, we are looking at increase in most of the pricing because of the inflation that's happening right now. So the labor costs and then the rise in the materials and the energy costs to keep the parks going and the maintenance and all that stuff. Especially on the expansions that Disney is looking to do. in 2025. Next is the content production. So Disney is looking to do around 25% less spending on its creating all its content. And with this, we are going to lower the pricing on the movies and our blockbusters to around 100 to 300 million. And then the streaming technology costs. So like I said before, we're really looking to invest in more AI. So we're looking around 200 million. And like I said before, the personalization tools, so people feel more involved and that the content is more directed towards them. Next, the licensing costs, so the royalties that are paid from the third party contributions, like Fox Entertainment and all that sort of that category. Next is the marketing, which we are looking to do heavy spending for promoting our films, the new attractions, the new destinations, and streaming. Last thing is the debt servicing cost. So the interest that Disney is going to pay on the outstanding debt, which we're looking around 4 and 5%. And with all this being said, the total cost that we're looking at for the cost assumptions is 42 to 49 billion. And with that being said, we can see okay, now finally, here is the income projections for 2025. So we have the parks and resorts, which also goes in hand with the merchandising. So we have all the ticket sales that Disney has at its parks, the hotels including for when people stay there, and all the merchandise regarding the toys, t-shirts, and anything. So from here, we're looking at the share revenue of 37%. And then next we have the media and entertainment, and then the entertainment studios, which includes the streaming, the Disney Channel, advertising, box office for the blockbuster movies, the licensing, and that share revenue is looking at 63%. Okay, so finally we have the funding needs. So as we said before, the parks and the experiences and the development of new attractions is a huge part of the money that's gonna be on our budget to develop new attractions and new experiences, and as well as sustainable initiatives. And then a 50% to streaming and media, to more content production, optimizing the platform, and just expanding it internationally. And then we are gonna dedicate a lot of our budget, as they said, into technology, not only on the parks, but on the streaming, using more AI and virtual reality to facilitate the customer use of everything of the parks and the media. And finally, 20% into marketing and just advertisement and global campaigns and partnerships. And that's it. Those are the sources.
Oh, thank you. That's it.
Oh, okay, so go to your funding needs, please. How much do you need for those?
So this is a 35% of our budget, and our budget is $104 million. So it would be
400, I mean,
104
okay,
100 million.
and you need 35% of the income to do the park experiences,
35%.
streaming and media, 15%. Go to the next, so we have 50%. Of your budget.
Budget in investment or budget in general?
No, the budget in investment.
Okay, what's the budget for investments?
It's on the other side.
Okay,
So maybe that will be in the research and development. part.
Okay,
That would be
Is that
like,
everything is divided into categories, so the one from the content production will be category content production, and it's all divided into 5 categories.
but that would be more into research and development, that part. Because development, like,
Yeah, the 15% of research.
okay. Okay. So it's 5 billions of funding needs, okay?
like 30%, 35% of those 5 million goes into parks, 30% into technology, 20% marketing.
Okay. Okay, and what are your highest expenses?
The operating expenses, so the stuff that we need to, for the operate the parks, all of our services, everything.
Okay, salaries,
Yes.
okay, for the parks.
Yes.
And what's, from all your incomes, what is the most profitable? You have a nice Mickey Mouse chart over the nice Mickey Mouse chart.
Yeah, it's entertainment.
Okay, but what's the most profitable from all of those? Entertainment
Like the
is the most
streaming.
profitable?
Just because it's
How do you know it's the most profitable?
because of the income. Well, the revenue that.
No, not based in the revenue, profitability, who brings more gross margin?
Or just, I think just based on the percentage of what the entertainment is. Maybe,
Maybe.
Yes. It's entertainment.
Okay, okay. Can you go back to the income statement, please? You're projecting less net income for this year?
For the rest of the 2024.
2025? What's your net income?
No, it's.
yes,
Why? What's happening?
I think there was a mistake in it doesn't make sense. So maybe it is wrong. That amount. The rest is good. Seems okay.
Thank you, thank you.
Hi guys, good morning. So today we're going to be presenting our Capstone project. I'm Isabella, I'm here with Natalie and Josias. So our objective is to present the 2025 budget proposal for Intel, which we will be covering their key financial metrics, operation plans, and investment strategies to drive growth, as well as getting our budget approved and passing our managerial accounting with a perfect 10. So let's get to know Intel. Intel Corporation is a leading global technology company, and it is a pioneer in semiconductor industry, founded in 1968. It also has a vast array of computing devices from personal computers to data centers. I'm a little nervous, I'm sorry. So our core business segments are client computing groups and data center and AI groups. Our Intel plants are worldwide. As you can see, most of our plants are in the United States, as we want to focus on United States manufacturing and being less dependent on global manufacturing, and our HQ is in Santa Clara, California. Our selling channels are direct sales, distributing and reselling, retail channels, and collaborations and partnerships. Our major markets, our biggest market since 2023 is China, having 14.85 billion of our total revenue, and the United States is also a great competitor. Intel's key clients, accounting for 40% of our net revenue, is Dell with 19%. I notice you both have Dell computers, so imagine having Intel as your processor. Group Lenovo and HP with 10%. So Intel recently, they have investments to expand their manufacturing capabilities with the aim of addressing global chip shortages, and they want to continue to advance their mission of enabling smart, connected, and data-driven futures. So how are we going to do this?
So our budget is divided into two parts. The first one is the projection, which we carried out through the analyzing the tendencies, and then we adjusted the projection and came up with our budget through data, external factors and internal factors available in the Intel company. And yes, we are expecting a 13% increase in sales. This is primarily because of slight recovery and growth across various segments, which will be explained afterwards, and also the release of the 18A, which is a new processor from Intel, and this is going to allow us to compete better with strong competitors like NVIDIA and AMD. And the next one. And other important factor is the net income, the profitability of our company. And we are expecting a 1% increase because of two factors. The first one is the 2% decrease in the cost of revenue. This is regarding the Intel 18A, which will be explaining the cost of assumptions, which will allow us to drive manufacturing costs and also raw materials down. And the other is the 3% decrease in the operating expenses, which is due to the layoffs and closing sites that Intel has been using as a strategy to lower down expenses throughout the years of 2023 and 2024. And most of the burdens are already taken by those 2 years. So this time we're going to kind of see the benefits of this strategy.
Okay, now for the sales assumptions, we have, for example, the client computing processors. This is like the super important part we have over here. Is the first one. It's about Dell, Lenovo, and HP. So the data center and artificial intelligence, Xeon new processor is the most important thing for our budget per se, because this new processor is more advanced in manufacturing processes to improve performance, efficiency, and competitiveness, like competition like NVIDIA. So we're also expanding to new markets such as network and edge Xeon for edge apps, and well, this Xeon processor is like heading to 5G infrastructure and autonomous driving technology and ADAS driving. So, for example, for BMW, autonomous driving. If we go by region, we have China, Singapore, US, Taiwan, and other regions. By region, with Xeon processor, we got to expect to gain market presence, remembering that this new processor makes it more attractive to data centers that it's very important for us. And for the direct sales and online channels that Professor told that is very important. For the direct sales, for example, we have the Dell and Lenovo Intel that we already told. And the hyperscalers, it's also an important part. So the customers over there, it's Amazon, Google Cloud, Microsoft, Meta, and Alibaba. For the online channels that we have today, we have Amazon, New Web, Best Buy, Flipkart, and JD.com for Indian and Chinese markets.
and the partner online retailers that you can have fun overview with distribution partners. We have Micro Center, DMH, Photo Video, Taylor Direct, and Stack Computers for the UK specifically.
As I mentioned before, we have a 2% decrease in the cost of revenue, and this is primarily because of two reasons. The first one is the release of the 18A processor. As Natalie explained, it accounts for the majority of our net revenue and profits. And the other reason is because of the process automation and decrease, which will decrease errors, labor costs, and make us more efficient. The thing with the 18A processor works, the last one, it was 7 nanometers, and now we are doing it at 2 nanometers, meaning in each silicon wafer, which will be explained maybe afterwards, which is one of our raw materials, it decreases the size, so more processors fit in each one, making us lower the cost of raw materials and also the efficiency. Increase the efficiency process.
Okay, so right now I'm going to explain the expenses assumption. So if we go for the marketing, general, and administrative, we have the expenses that are due to the Sion new campaign that it's targeting to new specific customers, especially for technology companies and gamers that are really important, having a very good processor for you playing video games. We also have the salaries for executives and administrative staff whatsoever. And the strategic initiative, for example, is that Intel allocates funds for administrative tasks tied to major transformation, such as the IDM 2.0 strategy. And this actually optimizes manufacturing processes and administration processes. The general expenses, for example, can go to the facility and infrastructure costs, maintaining office spaces and global research and development hubs. For the research and development, we have the new, what we're talking about, the CM processor and the IDM 2.0 strategy built upon.
Now moving on to the balance sheet, we have a 2.5 increase in the margin of the current assets. This is mainly because of the sales, increase in sales, and mostly the profitability we are increasing in our company. And also Intel is carrying out like a cautionary strategy where they are taking into account an increase in cash reserves and also a reduction in dividends, which was carried out in 2023, and we are maintaining it to focus more on key aspects like research and development, which are going to ensure our competitiveness. And also we have the short-term liabilities, which has a 1% increase approximately, and this is because of the layoffs and the R&D investments that we are doing. But even though it increases, we have the liquidity ratio, which increased like 10 decimals. It's not a lot, but since we are in a recovery situation, it's going to the right way, and this means we are able to meet our short-term liabilities with the current cash equivalents investments that we have.
Okay, and for our CAPEX, the first thing that you're going to notice is that from 2024 to 2025, we're projecting a decrease because, as Josias mentioned, we're trying to cut costs in a lot of areas. So for manufacturing, it is a 3 billion decrease. For research and development, a 0.5 billion decrease. For AI infrastructure, we want it to remain the same, as well for sustainability. For foundry services, it's a 0.5 billion decrease, and for global expansion, it's a 1.2 billion decrease. So the total CAPEX for 2025 would be 21 billion. And with this, we want to focus our investments in AI advancement, like the Xeon processors, in our Gaudi AI accelerators, as well as our advanced process nodes, like the 18A technology and our linear lake processors. And for our funding needs, as mentioned, we want to estimate at 21 billion. salute, and we want to focus on sustainability efforts and advanced technology investments. So of the 21 billion, 1 billion is going towards sustainability to continue our renewable energy transition, our water conservation and reuse, and our carbon neutrality. As for technology, we'll be giving 20 billion to it, with manufacturing and global expansion at 9.5 billion. As we want to expand our manufacturing in the United States, we need fabs to be able to expand and create more, as well as scaling back in our international projects and expansions as we've been posing various plans in Germany and Israel, as well as advanced packaging technologies. And our research and development will be 5.5 billion with the process nodes development, our AI-centric and hybrid architectures, and our AI ecosystem expansion, as well as our AI infrastructure at 3 billion, capitalizing on the AI growth of this new trend and this new generation, as well as competing with our competitors. And for boundary services, 2 billion by diversifying our revenue streams and our geopolitical advantages. So that's our justification for our funding needs. And we want to thank you for your time and have a happy holiday. Bye.
Those are the sources.
Can you go up to the income statement very fast?
Bless you.
Very good, guys. I have very few
Thank you.
I don't have questions.
Yeah, okay, thank you.
Okay, so good morning. We're going to present the Capstone project regarding Netflix. First of all, we have here our agenda, what we're going to talk about today. And we're going to start right now.
We're going to start about a brief introduction of Netflix. Netflix is a leading global internet entertainment service that offers a variety of award-winning TV series, movies, documentaries, among others, and they have a vast library of options that you can watch as a go-to destination streaming entertainment. And within the products and services, we have a subscription-based streaming service that allows users to watch different shows, TV, movies, and also they have the options of watching it in smartphones, tablets, computers, and also Netflix produces its own content and its own TV series as well as movies to also generate profitability. We're going to go fast through the market. They have a global reach, operating in 190 countries, and also their mission is to entertain the world through on-demand streaming on diverse stories to connect with people and also to keep them with the subscription. We also have the vision that is to be the world's leading internet entertainment service, offering the best stories to connect and to provide connections within the people. And also this leads us to the values that Netflix prioritizes: member satisfaction, innovation, responsibility, but also passion through cinema and TV series.
Okay, so now we're projecting the income statement. It's important to know that we have our base year, the 2020, and here we can see a little bit of the projection for the 2025, which will be the budget that we will explain a little bit later. But here's basically the important reference is the base year being 2020. So now we have the 2025 projection. Here's a little graph to explain it. As I said before, taking 2020 as a base year, we calculated that the 2021 revenue grew up to a 19%. We see that Netflix managed to grow and to recover significantly in the immediate year after the pandemic. Based on these calculations and external factors such as competitive landscape, consumer behavior, and any technological changes, we expect the revenue to grow 14% in the year 2025. This is taking into consideration 2024, so 14% more than 2024.
Okay, so now we have the balance sheets that show us current assets and short-term liability. As we can see, to 2024 and 2025 is expected to grow a billion as well as legal liability. This is a consistent growth in both aspects that we're going to see later on. That is because of the efficient debt management in Netflix. So it's not it's congruent, and they also have like a very strategic way of managing debt to keep the production of several TV series and movies, and also maintain a sustainable growth. So I'm going to explain the balance sheet with the growth trend. We can see total assets grew from 39 billion in 2020 to 51 billion, which shows us a 31.8 increase over 5 years, which is really good. And also, as well as I said before, liabilities also show a rise of 7.6%, which is a slower growth, but it is consistent and relative to the total asset, which suggests improved asset to, as I said before, debt management and also strategic business management. And also they have equity that they increased from 11 billion to 21 billion in 5 years, which is nearly the double, and also mainly from the subscriber base. And we have also the Netflix focus on long-term growth, not only to keep more subscribers, but also to keep it through time, and through investment in content, infrastructure, technology that we're going to see it later on, and also, as I said before, careful management of liabilities.
So now we have the 2025 budget that we kind of saw a little bit before. We know that there's an important thing to know is that everything is in $billion. So, for example, we expect the revenue for 2025 to be approximately $42-43 billion. That's, for instance, to take as an example, if we compare it to the 2024 revenue, which was around $37 billion, we know that we had a $5 billion increase. We expect a $5 billion increase in the 2025, taking into consideration all of the costs and expenses that we project here in the 2025 budget.
Okay, so now onto the sales assumption. As we said, the expected revenue for 2025, it's projected at 42 billion, which can be divided into 3 main segments, which is subscription services, the largest, advertising revenue, and other sources of revenue, which include mainly gaming and merchandise. So the subscription revenue is broken down into the 3 subscription options that Netflix offers to their users. The standard with ads, standard, and premium. Prices ranges depending on the quality of product that they will receive, standard being the more popular and premium being the least. So approximately between all these 3, we will see the 37.19 billion annual income. So for the rest of the assumptions, it is important to note that prices can vary and range from country to country. So for the rest of the presentation, we're going to assume that the global average for revenue per user is approximately $11.48 per month. So advertising revenue. Netflix is a platform where brands can advertise their products, and they have 3 types of advertising options for brands. Video ads that are the most expensive, banner ads that are static images that they can show around, well hidden in during their series, and sponsored partnerships where they will openly promote a product within their shows or TV shows.
So, for example, if you see a bag of Doritos perfectly displayed in a Netflix show, that's not accidental, someone paid for it and it's contributing to 10% of Netflix revenue. Other sources of revenue, gaming, this is in order to engage users beyond streaming and driving retention and do some sort of cross-sell opportunities, like maybe you have seen that there's some trivia crack options on Netflix and Black Mirror that are interactive sort of shows. And merchandising, selling merch from their shows, books, clothing, toys, any sort of artifact that can be sort of memorabilia for any shows or movies contribute to 40% of this part of the revenue. So expenses assumptions, marketing, production expenses, and other smaller expenses that still compose a big percentage. So the marketing is one of the largest. One in every 20,000 viewers converts into a subscriber. So if 500,000 people see a Netflix ad, there is a 2% conversion rate, meaning that they will get 10,000 new subscribers, 10 million new subscribers, from an ad that 500 million people saw. So the average in revenue being 11.94, that would mean 10 million new subscribers or 119.40 million in revenue from one single ad. So production costs, original content, production, series associated revenue from attracting and retaining subscribers for original content. Shows, for example, like Bridgerton or The Witcher, add 2 to 3 million subscribers per season, which contribute to approximately 25 to 35 million dollars each season that the show is streaming. And the other expenses are operational administrative functions that are necessary to maintain efficiency and to support some other core activities for the company. So now cost assumptions. Content production and licensing. This is different for first content production because this is more focused on the whole legal aspect of creating a whole new show. That's also expensive. And subscriber growth, things that are meant to attract new subscribers or to keep them. Operations and administration, technology and development, and debt services. So, as I said before, variety in content keeps attracting new subscribers and retains the ones that you already have. This directly impacts our revenue growth because subscribers are our strongest source of revenue. And licensing costs allow us to use third-party content to ensure a higher appeal from our subscribers. Then promotions, discounts, customer acquisition costs, all of these need to be budgeted as well. And they are essential for growing our subscriber base globally, especially when we're entering an emerging market or one where TV streaming services are not that popular. Then higher investment in brand presence will lead to an important effect on subscriber growth over time, which is why it's important to have it budgeted. Then operational and administration. This includes staffing, office operations, overhead expenses, the sort of thing of localized content teams for different regions, efficient operations to ensure the smooth day functioning of everything all over the world. Then technology and development. This is very important because R&D is key to optimize the streaming quality, to create personalized recommendations with AI, improve the algorithms, boost content discovery, and increase the perceived value of subscribers. And finally, debt services. While they do finance a lot of the projects out of pocket, Netflix does have important debt for financing content production, which requires periodic interest payments. Investments in high quality content are funded through debt in subscriber growth and result in subscriber growth and increased profitability. And also effective management of this debt allows Netflix to remain strong credit ratings and to continue to finance future projects. So it's very important to include them in the cost assumptions.
Okay, so now we're going to continue with capital expenditures. Here I'm going to explain about the allocation of investment. As Maya said, R&D is the most important aspect of Netflix streaming services, mainly because of the quality, but as also a significant portion of the this expenditure is allocated to producing original content. As also Maya said, producing an original content, for example, Stranger Things, it's about 8 million per episode, and also other TV shows, as Maya referred to, is 35 million per season. So as this is like a huge amount of the capital expenditures, mostly funding needs, annually would be 30 billion at least. And as I said before, it's all about the debt management. In some cases, in some TV series, it might be debt management. No, sorry, in some movies, it might be out of pocket. However, in some TV series, it's also all about debt management and conscious effort to reduce reliance on borrowed capital. And this strategic reduction in debt also boosts improved cash flows and management with operational efficiency. Thank you.
Thank you.
Very good. I would like to do one statement, please. At the beginning. You move. Okay, you have the budget here.
Yes, we added it to me.
Okay, so check systems. Okay, and the balance sheet.
The data that are missing is because they were not available in the platforms.
The presentation was, the look and feel was very, very nice, but these tables, I would recommend you to put a little effort on formatting the tables, okay? Because at the end, go to the next slides. You have a different, next, look, this type of tables. I guess, previous slide. It's more focused on. Then next, watch next. Okay, next. Go to the capital expenditure. Okay, and the funding needs.
Like we have that part only the cases, not only the fund.
The funding needs,
No, we only have like this part.
because how much do you need for the
Oh,
capital?
I said it is 30 billion, or if in total annually, because of it's 35 million per season. Per season they produce as an original per show. Yeah.
Per show.
Yeah.
So that's one season of one show.
Yeah,
Or
but
1 year.
yeah, so if we like added up all the seasons of the shows, it would be 30 billion, no, 20 billion annually.
20 billion.
Yes.
How much is the income?
Expected for
42, 43 billion.
43.
42 and 42.9.
It's over, yeah. Almost 43 billion.
Okay. And the costs are what you spend for all the shows, no? Go to the costs.
Not only that, but also
Cost assumption, that's it.
it's not only for producing, but also for operational technology and architecture.
So how much do you need for the capex next year? 20 billion?
Yes, because it's a lot of shows, and also not only popular shows, but maybe like
But how many per show? What shows are coming
It's depending on the TV show and also on the movie, but yeah, it's depending. But it's around 8 million per episode, $8 million per episode. So it's now they all have the same format of 8 episodes per season, like Stranger Things or Dark. So in the end, it's 35 or 20, 25 million per season of it. And yeah,
How many shows do you have?
uh, uh,
Okay. That's it. Thank you very much.
Good morning, Sharks. We are Airbnb, and we believe that anyone can belong anywhere. And today, we're gonna show you why you should invest in our stock. Our team is composed by Flor, Amiga Ariadna, and myself, Santiago Ricardo.
Okay, so the agenda, we're gonna tell you our purpose of our sales assumption, the cost assumptions, the expense assumptions, the income statement, balance sheet, year analysis, investment plan, with the capex and funding needs. Okay, so Airbnb was founded in 2008 by 3 roommates who wanted to earn an extra income to be able to pay their rent. So they started as renting air mattresses in their home, and the idea became wider, and they started Airbnb. Its mission is to create a world where anyone can belong anywhere, and they basically just offer accommodations anywhere in the world with affordable costs and different types of housing, like apartments, villas, houses, anything within your budget. Our sales assumption, so we divided it through income within different regions. So we did the 2024 and the 2025 with regression analysis in Excel. And so what we did was that we divided within the 2020 to 2023 the percentage within each region, and with the average of that, we multiplied it times the revenue that we got in our income statement. And so we got that revenue for 2025 would be 13.4 billion. And here we did the same, but with the bookings, which would be for 2025, 540 million. Value per booking would be $189, and the listings 8.9. And this is a comparison with this is internet based, and this is the one that we got through our analysis in Excel. So it's pretty similar. So it's we could say that it's really accurate.
Here in our cost assumptions, this table outlines the progression of our financial components from 2020 to 2024. The first 4 years we got them from Yahoo Finance. In 2024, we made it in Excel with the regression formula. And within the current liabilities, it shows an increase in each year. And the total non-current liabilities, it's almost always, it doesn't have any changes, like small changes in every year. And in the stockholders' equity, we have an increase almost each year, but most significantly in 2023. In this table, we break down the operating expenses. We have general and administrative, selling and marketing, research and development, and others. In general and administrative, we have a significant jump from 2022 to 2023 with more than 1 million. In selling and marketing, it's almost always consistently
the growth, focusing on promotional activities, planning research and development, the cost increase year on year, and in others, it's almost always increasing each year. With the total being 8,626,638. Now we have here the peer analysis. We choose Booking, TripAdvisor, and Expedia as our competitors. We have current radio, acid test, debt radio, debt to equity radio, and interest coverage. Equity radio, it's the proportion of assets financed by shareholders' equity. And we got it dividing shareholders' equity by total assets. The interest coverage is the ability to pay interest on its debt divided by the interest expense. And here in equity radio and interest coverage are the ones we are higher than the other.
Thank you for adding a brief analysis, but this is managerial accounting, right? Okay.
Okay, so next.
Well, we can see an overall positive trend in our income statement. The company has exponentially grown since 2020 to 2024. Some of the factors contributing to this positive trend, the strong demand, the increasing popularity of our platform, the effective cost management. We have been able to control costs, particularly in areas like marketing and operations, while maintaining growth. Diversification, we have expanded our offerings beyond traditional accommodation, including great experiences and luxury rentals. Also, we have improved operational efficiency because we have implemented operational efficiencies and streamlined processes to reduce costs and improve profitability. Then next. Here we can see our balance sheet, and some observations we can see is that we have experienced growth by increasing assets and liabilities. Liquidity, our company has strong liquidity position with increasing cash and cash equivalents. We have taken on more debt, which has been used to fund growth and operations, and we have been investing in the business, as seen in the stockholders' equity. Well, for our investment plan in 2023, November 2023, we invested in a startup valued in $200 million from the co-creator of City. It is an AI software that we want to implement to power our platform and provide a better service to our customers. In 2024 was different. We had no capital expenditures besides the investment of our own stock. And we think this reflects confidence in our financial health and commitment to the returning value to our stakeholders. So that's why we think it's a good investment. Our funding needs, Airbnb does not have funding needs, as all our expenses are covered by revenue. We can see here that our total revenue is bigger than the cost of revenue and operating expenses, so that's why we currently don't need funding needs. We don't have funding needs. Here in the budget assumption, the table presents the project cash and cash equivalents for the year 2020 to 2025. The values are increasing over time, suggesting a positive financial trend. The most accurate is 2024 because It's hard to know 2025 because we're in the last period, on the last quarter of this year, and it's a little bit hard to estimate budget for 2025. And well, thank you, and you're ready to invest in our shares.
No, to accept the budget.
So,
Let's go past that.
no problem.
First of all, go back to the income statement, please. Okay. Okay, what happened from 2023 to 2024 and why 2024 is lower and now you increase in 2025 but less than 2023?
Lower where?
You have 2023 ends up in net income of 4.7.
Nine.
Net income 2023 4.7. It's 4,792,000 in 2023.
So what happened was that with 2024, we didn't have the final, since the fiscal year is not done, the TTM value that we
Okay,
had.
so then why 2025 is not better than 2023?
Because what we did was that we multiplied it by I have the formula in the Excel, but it was that we multiplied it with the TTM, and so some of the values were not very accurate. And even, because that's true, but some of the values even gave us negative because of the TTM. Because it was not the final value, so it's like an estimate.
Yes, you should have avoided 2024.
So we did it, since we did it with the regression line.
Yes, the income assumptions, I got it. I wouldn't use all this linear regression, but I got it. I passed the income assumptions. Go to the next. What's the balance sheet budget?
The budget. So, what we determined as a budget was the cash and cash equivalents, and that, if I remember correctly, was the cash and cash equivalents and short-term investments minus other short-term investments minus accounts receivable minus other receivables.
No, but I want to see how will you end up in current assets in 2025 and current liabilities in 2025.
Since we used the information we had from Yahoo Finance was only till 2023, so we were only able to do the 2024 balance
Yes, but the
sheet.
budget is for 2025.
Yeah, so what we did there was that we so we got the 2024 budget that they used, and we did another regression line, and so that's why in the budget at the end in 2025 there is a little bit of a decrease, because since from 2023, that since they used in 2024 they didn't use much money in the capex, it jumped the budget. So
Go next. Go to the capex. Explain me the capex. How is it that they are not investing?
There, we looked it up in many sources, and as you can see here in this chart from finance charts, Airbnb is only investing in their own stock currently. Last time, as I mentioned, they bought this AI software. But yeah, currently in 2024, that's only capital expenditures.
Okay, but on in 2024, but 2025, that doesn't mean that they won't have, because by 2024 you will purchase your own stock, no? In 2023, you purchase a company, Game Planner AI. So in 2025, what are you gonna do? How much do you need? What are your funding needs?
funding needs, well, since all the costs of expenses and it's in the next slide, of expenses and the cost of revenue, they're covered by the total revenue that we expect to get in 2025. So there would be no funding needs, but the budget that we see as needed for the cash and cash equivalents, which is the money that we need on hand to be able to operate on 2025, would be about 12.1.
Yes, but you already have 12 by the end of 2024, so you don't need.
Yeah, it would be covered by
Go
the
to the
revenue.
risk analysis that you did.
Here or
Yeah.
Go to the next. Okay.
the ones on like black
Are the-
are the ones that we
Do better.
do better than the competitors.
Okay. Thanks. Thank you.
Thank you very much.
Thank you. Chicos.